one thing that really touched my heart when we were doing that session was what she said about doing smart goals for your financial plan. I've always heard about smart targets in terms of school and whatnot, but I've never thought to apply that knowledge when it comes to finance. So in this session, expect to hear nuggets of truth that you wouldn't hear anywhere else. If you're already knowledgeable about the subject matter, prepare to be refreshed on a couple of things. But what I can highly recommend is that Rachel knows what she's talking about. Rachel is highly experienced in this subject matter, and just keep your ears attentive, because what you're about to listen to, one sentence, one word, one phrase could change your financial destiny forever. So ladies and gentlemen, let us give a warm welcome to Rachel Muthoni.
Thank you very much, Kevin. I think for the benefit of those who don't know me, I will just switch on my video for a short time. So at least you can put a face to the name before we get going. And then just for my bandwidth, I'm going to switch it off and go through the content as we go along. So thank you very much for having me, Kevin. I think it's a good sign after the first session that you would want me to be back again. As you were going through the intro, I was thinking, is that me? Yes, I guess it's me. So thank you very much for that. And thank you to those who have joined, especially my class of 2011, Sharon, Ida, Cleo. I see you guys. Thank you for the support. And some of my coaches, Beatrice, thank you for joining. I'm very excited about today's session. Investments are close to my heart, and I hope that you will be able to take away some good stuff at the end of this session. All right, so let's get right into it. So before this session, I just asked Laurel to do a sort of a survey and find out what you wanted to hear about investments. And some of the things were how to determine viable investments, what are the best investments for students. Some of you wanted to hear about crypto, mutual funds, MMF, circles, what are the opportunities for investments in Kenya. Some of you want me to talk about real estate. Someone talked about how to make quick returns. I don't know whether I'm going to be able to answer that one. And a lot of questions around Forex trading and compound interest and how that works. So you will hear about that and more as we continue with the session. And maybe just before I get into the investments part, maybe just a brief recap from what we talked about last time. One, that personal finance is a very personal journey. You have different experiences, different needs and priorities, and different timelines. So it's very important for you not to compare yourself with others. As we talked about last time, your money will come in phases, and it's important that at every phase of your life, you are able to identify the best use of your money. We also talked about the key to financial independence being spending less than you make. And we talked about whether you make $1 million or whether you make 100 shillings, as long as you spend more than you make, then you will not be able to set aside money for investments and growing your income. Then we also talked about buying yourself time and freedom by delaying gratification, which is very important, especially when now we start talking about investments. The importance of starting now as opposed to waiting. And we also talked about building your knowledge as you go along, which is why sessions such as this are very important. And finally, anyone can build wealth, anyone. As long as you are able to live within some of these principles, you will be able to build wealth. So then for today, what are we going to talk about? And I would ask maybe Kevin, you could take the questions in the chat and you can interrupt me if there are questions. I'll also just be taking some breaks. If there are any questions, post them on the chat and I will be able to go through that. So what are we going to talk about today? We'll talk about some basics of investments, which are risk and time, and finding money to allocate for your investments. We're going to talk about different types of investments and what are the returns that are associated with these investments. And finally, we're going to talk about how to evaluate investments. And that should answer the questions of where is the best part for me, what is the best investment for me to put my money in, and questions such as, should I put my money in crypto? Should I put my money in forex trading? Should I put my money in a SACCO? So I hope that once we go through this, you will be able to answer some of those questions. So I'll also give a disclaimer that the information that I'm going to give you, some of it is publicly available information. It's just a collection of resources as I go along, and also from my own experience as an investor. It is in no way guaranteed to make you returns, but I hope that it will give you some, it will help you to build a foundation, especially because I will not be saying, go and put your money here and go and put your money there. I will be talking about what are the different places you can put your money in, and what are the different returns, what is the risk involved, and then you can be able to make a decision from that information. All right, so one of the key basics of investments is risk. You cannot talk about investments without understanding risk. So what is investing? Investing basically is allocating your money with the expectation of a positive benefit or return. Allow me not to share my screen because it's a lot of notes, and I want to avoid you reading the slides. Just try and just listen. I've switched off my video, unfortunately, because of my bandwidth, but I'll switch it on maybe during the Q&A session. So basics of investment, I talked about investing, being able to allocate money with the expectation of a positive benefit or return in the future. And how do you do this? You start by saving, because then you must have some money that you want to put into your investments. So when you invest, you expose yourself to investment risk, which is the probability or uncertainty of loss rather than expected profit from the investment, maybe due to a fall in the fair price of your investment. Then we also have a return, which is the profit that you earn from your investment. And then we have inflation, which is the general rise in the price of goods in an economy over a period of time. So you find that you are only able to buy fewer goods or services with the currency that you have. And that brings me to what people will talk about as a risk-free rate, which is it's a theoretical rate of return of an investment with zero risk. But we know that in practical terms, there is no investment that is completely risk-free. However, most people use the annual T-bill rate or the 3-month T-bill rate as the risk-free rate. But then you also need to consider inflation. So when you look at a situation like Kenya, where you have your TBL rate, the 3-month is 6.6 and the annual one is about 7.4%, and you have an annual average inflation rate of 5.87, then it would tell you that the only risk-free rate there is about 1.53%. So that's really what we could call a risk-free return, but we know that in some instances, even government securities may not be risk-free, because we've seen in some instances where governments may fail to honor their obligations. So what are the different types of risk? All right, so some of the risks that we will talk about include market risk. So what is market risk? It's really the risk of your investments declining in value because of economic developments or other events that affect the entire market. So this, a good example is like this COVID and what has happened in the market, especially in the real estate sector, that has impacted investors. It's a risk that you undertake as long as you invest in the market, and you may not be able to mitigate against it. We also have liquidity risk, which is that you are unable to sell your investments, especially if you hold your investments in investments that are not highly liquid. So it means that maybe when you need the money, you're not able to get it out as fast as you can. You could also have concentration risk, which is the risk that you expose yourself to if you only invest in one type of investment. So that means your risk is all tied in one instrument. You also have credit risk. And this is when, especially when you're investing in things like bonds, corporate bonds, government bonds, it's that the risk that a company or a government would run into financial difficulties and it will not be able to pay you the interest or your principal at maturity. Then you have what we also call reinvestment risk. Now, reinvestment risk is the risk that you expose yourself where you suffer loss from reinvesting your principal or income at a lower interest rate. So maybe something happens in the market, and now when you're reinvesting your returns, you're doing it at a lower rate. You could also have inflation risk, as we talked about, that, and this happens over time, the risk of losing your purchasing power because the value of your investments does not keep up with inflation, which is why as you go along investing, it's important to adjust your investments with inflation. Then you have a horizon risk. And this is the risk that your investment horizon may be shortened because of an unforeseen event. So maybe you've invested in something for 10 years, but then unfortunately you lose your job and you need to take back your investment. That would be horizon risk. Then you have longevity risk, which is the risk of outliving your savings. We don't think about it enough. I think the assumption is that we will all our savings will outlive us. But unfortunately, there are some instances, especially where if you haven't planned well enough for retirement, there is the risk of outliving your savings and then struggling for some years. And finally, we have what we call foreign investment risk. And this is really the risk you expose yourself when you're investing in foreign countries. So that's those are some of the risks. It's not an exhaustive list, but I think it's very important for us to understand before we start talking about investments. It is good to understand that every time you invest, you do expose yourself to some form of risk. And I think you all know that the higher the risk, the higher the return, and vice versa. When you are taking up more risk, you're likely to make more money from your investments if you or lose more money from your investments. And if you're a conservative investor, you're likely to preserve your capital, but also not grow it as much as you want. Do we have any questions up to this point? Okay, if we do not have a question, I'll move on to talking about time. And the reason I want to talk about time is because when you look at risk, the market generally has a way of correcting itself, and it will correct itself over time, which is why it is important to give your investments time. So you could have different time horizons. So you could have a loss in the first year, but if you're investing for 10 years, in the long run, research has shown, and even in practical sense, that the market generally will correct itself over time. And so if there are losses one year, you will recover in the next, or there might be a dip for a few years, and then the market will go back to making returns. And an interesting fact here, I think you all know Warren Buffett. So Warren Buffett bought his first stock when he was 11. And the interesting thing is that nearly 94% of his wealth was earned after he turned 60. So success comes at any age. It's also a very good example of how compound interest works, and we will be able to go through an illustration of how compound interest works. And his net worth when he was 52 years old was $376 million, and 99% of that came after he turned 50. So give yourself time. As if you want to grow your money through investments, then time is one of the things that will really work to your advantage. Okay, yeah, so someone talked about risk, and if I could talk about some risk management measures, and I hope that as we go along, I will be able to answer that question. So let's move on to what are then the different types of investments, and I'm going to talk about how you can manage your risk with each of these different types of investments. So when we talk about investments, we have either investments that will give you fixed income, such as a dividend. You could have some that appreciate in time and give you earn capital gains, and you also have some that will pay you an interest over time. It could be simple interest or it could be compound interest. So what are some of these instruments? So one, we have cash and cash equivalents. These are like your fixed deposits, your certificates of deposit. These are very low risk investments, and therefore they will also give you very small return on your investment because you're not taking as much risk. And you can get this through your bank. You could just go and open a fixed deposit account and put your money there. Then we have other things such as SACCOs. And I put this here because a lot of you asked me to talk about SACCOs. So a SACCO is really a savings scheme. They largely started as cooperatives for people in the same profession. For example, that's why you find that most SACCOs are affiliated with companies. You have maybe like the Stima SACCO, Mwalimu SACCO, Safaricom SACCO. Those are SACCOs that are they bring together the people in that profession or that sector. They could have some restrictions. So you may find that some SACCOs do not admit people from other sectors, but I've found that most organizations will also have like a company SACCO that they will start. They're a good way to create a savings culture. Because they encourage you to save. They could also help you to get into other investments because they have investment products such as maybe real estate, where they help you to pay for the investment. They allow you to pay for the investments over time. Sorry, just give me a moment. All right, sorry about that. So I was talking about SACCOs. They encourage a savings culture. They could also help you in getting into other investments such as real estate because they allow you to have a payment plan. They also provide you with credit if you need it. At maybe 3 to 4 times of your savings and at a lower rate than what you would get at a bank. So what is the risk of getting into a SACCO? Some could be mismanaged. So one of the ways you can manage this risk is ensuring that you are confirming whether this SACCO is registered. We have a Societies Regulatory Authority, SASRA, which is mandated with licensing and regulating the operation of SACCOs in Kenya. So you can check, and even on their website, they give a list of SACCOs that they have licensed and regulated. Then I'll move on to bonds. If you have any questions, please post them on the chat. Then we move on to bonds, and a bond is really debt investment. It's lending to a company or a government. Most bonds will give you a steady stream of income because they will pay you interest annually or semi-annually, or even sometimes quarterly. I'll put so in Kenya you have the option of buying treasury bonds, which are fixed rate, and this means that the rate of return is or the rate of interest is determined at the auction when the bond is being auctioned, and it is locked in for the entire life of the bond. So if they say it's a bond that is 10% interest, that means for every year you get 10% of your return paid either semi-annually or annually. Now, the government of Kenya also offers occasional tax-exempt infrastructure bonds, which are a very good form of investment because they are free from taxes. And most of investments in Kenya are subject to tax. So even where you earn interest, it is subject to withholding tax. So a tax-exempt infrastructure bond would give you a return in full for the entire life of the bond. So what are the disadvantages of investing in a bond? One, it's fixed. They do offer an option to auction your bond during the life of the bond, so you could be able to get your money. However, generally you want to get into a bond for the longer term. You also earn simple interest. They do not compound the interest. And of course, there's a risk that the government could fail to meet its obligations. We haven't had that in Kenya. So I don't think we would, and I hope we don't. And then how do you buy a bond? Right now, it's much easier to buy a bond right now. You can buy it through your bank or through an investment broker. And you just need to, they normally have, I think, a minimum of 100,000 shillings to get into a bond. Okay, so these are some of the lower risk investments that I've talked about, and now we'll start getting into the maybe medium risk and maybe medium return, so slightly higher return than what we've talked about. So you have your mutual funds, and a mutual fund is basically an investment or an instrument that allows different people to pull in their money together and invest it into either the stock exchange or directly with corporate bonds with some companies. And the advantage of mutual funds is that they help you to balance out your risk, because you are not going into the market as an individual investor, you are going in as a group. Mutual funds could be three types. We have one, which is the most common one, and I think most people are familiar with, which is a money market fund. A money market fund, I would classify together with what you have as your cash and cash equivalents. It's low risk. It doesn't earn you a great return. It's a great way to accumulate your money for investment. You earn an interest, which is compounded either monthly or daily. And then you're also subject to withholding tax on your interest. But it allows you, it is better than just putting your money maybe in a bank account that's earning a 2% rate. With money market, you could earn, they give you, because they invest in the T-bills and bonds, mostly T-bills, they could give you up to the 7.4% or slightly higher for some that will undertake more risk. But then again, the risk with this is you need to get into a fund that is managed by a reputable company with a strong asset base, and they have a strong custodian bank. So some examples of companies that have MMFs include CIC, Sanlam, ICEA, Britam, Old Mutual. So you have a wide range of companies to choose from if you want to get into a money market fund. Money market funds are generally short-term investments. So this is if you're looking at a year or 2 years of holding your funds, and you would also be able to recall your money very fast. So I also recommend them when I am talking to people who want to build an emergency fund. Could be a good way of building an emergency fund that is also giving you some return and that you can be able to recall. Most of these companies, when you recall your money, you will have it within 2 to 3 days of recalling your money. Then you have, we have a dividend fund. Now, a dividend fund is medium-term investment, and these ones will give you slightly higher interest, maybe 12 to 15%. They will invest in different things. So they will have government securities, they will have the money market, they will have commercial papers, they could have publicly traded stocks in their portfolio, and they work, they will pay you a dividend at the end of, maybe at the end of the month or at the end of the year. It depends with what sort of arrangement that you have gotten into in the dividend fund. Then you have what is called a balanced fund, which is sort of a mix between your money market and your dividend fund, whereby whereby you buy a unit of the fund. So they'll probably say this fund, a share in this fund is maybe 100 shillings. So you can buy like 10 shares of the fund. Now these are longer term forms of investments, and you realize that your gains through capital gains, where if you hold it for a long time, the share price or the price of the units of the fund will rise over time. And so in future, if you want to sell off your investments, you're able to sell it at a higher price and recoup your investments. So all this, again, you could find them in with the companies that also have MMFs. A lot of them also have the balanced fund and the dividend funds. So the same companies I mentioned, CIC, Sanlam, Britam, Old Mutual, ICEA, that are offering these investment products. Then you have a more risky investment, or which is also high risk, high return, which is stocks. And these are what we commonly call shares. This is where you buy a share in a publicly traded company, and you wait for either the share price to go up. So what then do you do to buy a share? How do you buy shares? One is you need to have a CDS account, and you can open this with a stockbroker or an investment bank. And then you decide what stock you want to buy. So you'll go to the Nairobi Stock Exchange, you look at what shares are trading, maybe do some background research on the companies, maybe their trajectory, just learn a bit about what you're going to invest in. And then once you choose your stock, you buy it, and you can hold, some people do it for speculation, but generally, if you want to make returns from your investments, I would encourage you to have a long-term view. Then we have real estate. And I think this is one that is very prevalent in Kenya, where people will directly buy either apartments or land, or just some form of asset in the real estate sector. Very high barriers to entry in terms of the kind of money outlay that you need. So it's probably an investment you want to save up towards, or if you can get the options like in the SACCOs that give you an option of paying in installments, it could also it's one of the sectors that could also be highly misused. And if you're not careful with your research and if you're not following the right channels, you could end up losing your money. So if you're going to get into real estate, get into it with a good lawyer, do your research, follow the right channels, and like I always like to say, buying real estate is not like going into the shop and buying clothes. So you just need to be a little more careful and then before you put in your investment. What are the advantages? Could have very high gains over time, but then it could also fall really fast, like what we've seen in COVID, especially where the sector has been impacted by something in the market. And it is also now I've lost my train of thought. I read the chart and I lost my train of thought. Yes, I remembered. So it is not highly liquid. So when you have your investments in, if you have investments in real estate, then you could be exposing yourself to a liquidity risk, the risk that you are not able to liquidate your investments as fast as you can when you want to, because that is affected by factors in the market. However, you can balance out this risk by ensuring that you have a diversified portfolio. Then for those who want to invest in the real estate sector, but they do not have huge chunks of money to go right into real estate investments, you could go into real estate investments through a real estate investment trust. This is a company that is formed or that owns or finances income producing real estate across a range of property sectors. So in Kenya, we only have one publicly traded rate, which is the Stanley Fahari I-Rate. And this is an investment that allows you to get into the it allows you to get into the real estate market. And rates could be in two forms. You could have an income rate, which is where investors will pool their resources and acquire long-term income generating real estate, for example, housing, commercial, and other real estate. You have a development rate, which the investors will pool together their resources to acquire eligible real estate for development and construction projects. Then you also have Islamic rates. It's a rate that primarily invests primarily in income producing Sharia compliant real estate. So what are the advantages of rates? One is that in Kenya right now, they are exempt from VAT, and stamp duty they're exempted from stamp duty when you're transferring assets to rates. They could also give you a steady income stream. And then because of, we talked about the illiquidity of a real estate investment, when you have a rate, you can easily convert it into cash by selling the units that you hold in the rate. And of course, they are managed professionally, and that means that you are you get a more qualified person to manage your investment. However, just like real estate, if there is any factor in the market that impacts rental income, or maybe people will terminate their leases, then it would mean that your income reduces. If there are any economic or political situations that impact rates, then that would also impact you. And right now we know they are tax exempt, but we don't know what will happen in future. So those are some of the things that you need to know about a rate before you get into one. Then we have what we call ETFs. Now, ETFs are exchange-traded funds. They're similar to mutual funds in that they are a collection of investments that track a market index. But unlike a mutual fund, which you buy through a fund company, for example, like ICA, Sanlam, and all that, an ETF is publicly traded you buy it off the stock exchange. So in Kenya, we only have one ETF, which is the ABSA New Gold ETF. And this is an ETF that tracks the price of gold. It was formerly, I think it's also traded on the JSE. So it's one way that you could get into the commodities market by buying a unit of this trust whose price is determined by the prices of gold the global prices of gold. So that's one way of also investing. How do you buy it? You can buy it through a stockbroker or an investment bank, and they are listed in the NSE, the different partners that you can use to buy assets off the stock exchange. Then you have other investments. Some people will collect art or jewelry and have that as their investment, and they could sell that in future. Of course, the risks involved with that include that if you're holding it in your house, it could be stolen. Your house could burn down. There are different risks that are involved, but you could manage that by either maybe getting a safe and having some form of storage that will preserve your investment. You could directly buy gold. I don't know whether, I'm not very sure whether you can do that directly in Kenya. Maybe you can. I know in South Africa, it's a very vibrant market where you could actually buy gold and hold the metal. Then you have and then the other two investments that I will talk about, I've put them in here as investments because they are upcoming investments. However, I also must say that these are more professional or more expert level sort of investments. So one is Forex trading. So Forex trading, and I'll talk about it because a lot of you asked about Forex trading. This is where you basically buy currencies and trade in them. I think it's an expert area. You need to understand how currencies work. It's a high risk investment in that it's a very volatile market, and you could very easily lose your money. But how do you go about foreign currency investments? You need to have a brokerage account, so which is the place where you will hold your foreign currency. It's called a brokerage account, and there are different brokerage firms online that you could use that you can open your account in. Then you put money in your account, have a strategy of how you buy your currency. So you need to be studying how these currencies are moving, what is the economic outlook, so that you can make an informed purchase. Then you pick your currency and choose the right type of assets. So they will basically give you 3 ways of investing. So you could have an option. So currency options, they will give you the ability to buy or sell currency at a set price at a specific date. And so if this works, you exercise your option for a profit. You could also have a future, which they're almost like options, but instead of having the option to exercise at a set time, you must exercise your contract when it's up. So that's the future. Or you could get into a mutual fund or an ETF that is holding stocks in bonds or even in currencies. And I think we talked about ETFs. And I'll also mention that if you are interested in investing in foreign currency, there are different ways to do it, even when you're in Kenya. So one is to go the Forex trading way, and the other way is to also get into ETFs that hold their investments in other currencies. So for example, StanChart has some products where they have some USD ETFs that you could purchase for as low as 10,000 shillings a month, and you keep building on your fund. It's lower risk than going directly into Forex trading, because then again, as I said, a mutual fund works when investors are pooling their money together, and then the company that is managed by a licensed fund manager will now go out and invest in the market. Okay, and then any questions so far?
Yes, they are.
Yes.
Mark asked if you could touch on the measurements of risk, which I think you talked about. But then he then asked, how do you buy bonds?
Okay, so let me answer that. How to buy a bond? Quite easy. One, if you can buy directly through your bank and invest directly with CBK. Banks offer this option. Secondly, you could go through a stockbroker or an investment bank, and they are listed on the NSE website. I know a bank like StanChart, and I'm going to use that because that's the bank I bank with. They have the option of, they have an investments option where you can even do it on their app, where you just you do an investor profile, and then you can select which bond you want and just fund your account and buy the bond. So it is quite easy to get into bonds. Then someone asked, how can you buy stocks from companies abroad? Well, in Kenya, and if so, how? I've mentioned the foreign currency ETFs that are available, and I think they should be available even with other investment companies, maybe like ICA. I'm not sure, but you could check, where they allow you to buy now shares in those funds that will hold those shares. So for example, if you buy a tech fund, it could be a tech fund that holds shares in maybe Amazon, Tesla, and the like. And so you buy a share or a unit of that fund. So you would need to have a USD account. So and again, I'll just give the example I am familiar with. So for example, with StanChart, you typically, they give you the option to invest, where you will fund a USD account and then buy a fund that invests in stocks. Not very familiar with how you can directly buy a stock off the foreign exchange markets. So that's maybe something I could also research on and see what are the possible ways. Okay, let's see if there's another question. How much do you need to start in real estate in Kenya? It depends. It really depends with where you're buying. You could buy for as low as 30,000 for an acre in some West Pokot or different parts of the country. If you are in Nairobi, then it's much higher. Right now, with the devolved governments, there are a lot more options. And as counties continue to develop, it might be of interest to you to start looking at what else is outside of the city that you can invest in that is not too highly priced but has potential for growth. Now, if you don't have that much money, then the easiest way then is to buy a rate where you just buy a unit of the fund that is in real estate and use that income you keep saving that income so that eventually you are able to get into the real estate market. Another way that you could get into the real estate market is if you have like-minded friends, you could all pull your money together and say, we want to own an acre in Karen. How much is it? 60 million. How do we raise 60 million as the 4 of us or the 5 of us? So you could also find different ways of bringing your funds together, even through chamas. There are these different ways that you can use when you don't have all the money that is needed. You can pull your money together with your friends, with your chamas, or you can then directly go and buy a rate. So I think those are some of the easy ways to get into the real estate market, but also look outside your circle. Don't just look for land within the Nairobi County. So try and diversify, move outside of Nairobi. You might find very good assets for a price that is not prohibitive. Okay.
Before you continue,
Uh-huh.
I'd just like to ask my question because it's still on real estate. You mentioned about the right channels someone should use, but you didn't go too deep into it because, and you would also mention that real estate can be very risky and you have to do a lot of research. So could you elaborate on good sources of information that we could use, either agencies we can contact, and then the right channels we can use as we go into real estate?
All right. So thanks for that. So when it comes to real estate, yes, there are a lot of mushrooming companies that are selling land. And I think you all see the ads on TV. I will not say I recommend A, B, or C. But what you need to find out, so generally when you're buying land, you want to make sure that this land is real. So first of all, you want to go and visit the land. You also want to get a copy of the title deed of the land and do your own independent search. You can do it individually or you can do it through a lawyer. So what you do is you go to a Huduma Center, you download a search form, they will tell you the documents you need. I think you need your ID, your PIN certificate, you need your ID, your PIN certificate, the search document, and you also need a copy of the title deeds. And then you submit that to the land registrar offices. So wherever so if you're buying land in Nairobi, that would be your registry in Nairobi, or if you're buying land outside of Nairobi, it could be the different land registries in the different counties. So you will submit that for a search. So what a search does is it tells you if there are any encumbrances on the land, whether there's any caution on the land that you should be aware of. And then, of course, once you do that and you've cleared and you've done that independently, what you do is then you would typically get a lawyer to draw up an agreement that details how the land transaction will be done, how the transaction will be done, what the payment terms are, and what parties are responsible for which costs. And then, of course, you make your payment and then you start the process of registering the land or the asset in your name. So typically that's the process you would follow. Now, when you buy land through maybe like SACCOs or these other investment companies, I still insist if you can still do the process for yourself. The assumption is that these companies will have gone in and done the due diligence, but I don't think you can ever be too careful. So I have in instances bought land through an agency that I assumed had done the due diligence, and then it turned out like 3 or 4 SACCOs had bought the same land. So it's still possible that you could get into a bad deal. But then again, that is what investments are about. But then also, if you've invested with a reputable company or a SACCO, then there would be some ways of getting reprieve. So also study the company. Look at what is the background of the company. Are there any cases or reports that they could be misusing people's funds before you get into it? And I think those are some of the actions that you can take to protect yourself before you invest.
Thank you for that. If you have any other questions, feel free to send me a direct message if you don't feel comfortable chatting to everyone. And when she asks if there are any questions, also feel free to raise your hand and speak. Yeah.
Okay. All right. Then I'll talk about crypto. It's a hot topic. So what is cryptocurrency? Cryptocurrency is basically a digital currency, which is an alternative form of payment created using encryption algorithms. I'm sure those people who are more familiar with IT terms could have a better understanding of the crypto market. There are over 10,000 types of crypto. The most common one, or the one that is mostly talked about, is Bitcoin. So Bitcoin is just one form of cryptocurrency. There are many, many different types of cryptocurrencies. Now, I must say that in Kenya, I don't know whether the CBK has lifted the warning that they had given the public. They had indicated that cryptocurrencies are not regulated in Kenya. They are not legal tender. And so if you are investing in cryptocurrency, you're taking that risk as yourself. And the government is not liable because in most markets, they are not regulated. They are a very speculative form of investment where people will buy the crypto and expect it to, or hope that it will increase in value. And then when it increases in value, you sell off your investment. They're very high risk, as I said, but then that also means they're also high return. But if you've also been following like the prices of Bitcoin, you see the volatility that it has in the market. Now, how do you get into this? You need an online wallet where on an exchange. So there are different exchanges like Coinbase where you can go in and create your online wallet, fund your account, and start buying crypto. The challenge with crypto is also that there are very many fraudsters in the industry, and because it is not regulated, you have to be very careful not to fall into the hands of a fraudster. That said, I'm not very, I don't trade in crypto, so I'm not very familiar with it. Generally, I prefer to invest in things that I understand and that are regulated. And that's just because of my own risk profile. So for someone who has a risk profile that is more, who has a higher risk appetite, that could be an investment option for them. Yeah, any question? Okay, then before I move on to how to evaluate investments, I'll briefly touch on other instruments that people could use as investment channels that could be debated whether or not they are investment channels. So you have maybe like a retirement plan. That is an investment where you keep putting money towards that you can spend in retirement. You could do this individually, or you could do this through a company. If you're employed, you could do it through a company. But most insurance companies also offer different pension funds that you could get into individually, especially if you're self-employed and you still want to save for retirement. Then you have other things such as life insurance plans, which nowadays companies have sort of adjusted that maybe it's a return with maybe dividends. I think they call them bonus payments every 4 years. They are very, very low risk forms of investments, again, available with different investment companies, ICEA, Britam. They all have these products. Very low risk, but also good if you have dependents and you would want to ensure that if in the event that you are to die, then your dependents would get a share of your investments. So, I mean, that's how a life insurance works. So it's debatable. Are they really investment opportunities? Typically, they will not give you the returns you would get with a higher risk return, but then they have their own benefits, such as maybe they'll give you disability benefit or accidental benefit if you get into an accident, or if you die, terminal benefits, taking care of last expenses, things like that. So you could also see it as a way to diversify your portfolio. I don't know whether there is any investment that I have not covered that you would like me to get into, and hopefully it's one that I am familiar with. Okay, if there are no questions, I will move on to compound interest. I think someone asked about compound interest and how it works. And I think I want to share my screen just so I can illustrate how compound interest works. Let me know if you're able to see my screen. Can you guys see my screen?
Yes, we can.
Okay, fantastic. So compound interest is the assumption is that we all understand simple interest. So simple interest is basically calculated on your principal. So if you invest 1,000 shillings and they tell you the rate of interest is 12%, so at the end of the year they'll work out 12% divide by 12% times your 1,000 shillings, and that will be your interest for the year. How then does compound interest work? Compound interest is different from simple interest in the sense that it is interest that is paid on interest. So if you have 100 shillings, if you invest 100 shillings today, and you have a compounding rate, most companies will either compound annually, monthly, or daily. So every day they will work out what your interest is. And then on that interest, so if the next day your interest is maybe 150 cents, sorry, your interest is 50 cents. So the next day they will work out your interest on the 150 cents and get the new amount. So every time you earn your interest on top of you earn interest on your principal plus your interest. Now, compound interest has been called the eighth wonder of the world, and I'll show you why. Because if you are investing in something that is giving you compound interest, it gets to a time where your interest payments are higher than your monthly investments. So I'll just show you, and you can find compound interest calculators online that you can use to simulate what it looks like in different years. So this is, in this assumption, I just ignore the dollar sign. It's because this was the sign that was available on the calculator. I just assumed that here you are investing 5,000 shillings every month. And I also assumed that you are adjusting your deposits with inflation. So I used the inflation rate of 5.87%, and I used a very conservative interest rate of 8%, which if you are getting into maybe like a balance fund or a dividend fund, you could get up to 12 to 15%. So this is a very conservative way of looking at it. So in 5 years, you see you have total monthly deposits of 330,000 and you earn an interest of 74,000. Now in 10 years, same assumptions. Your deposits are about 786 and you've earned interest of almost half of your deposits. Now, when you get to 20 years, this is really where the game changes, because then again, time is working for you. And in 20 years, your monthly deposits are actually lower than the interest that you have earned. And this is where now the game starts changing. And as I said, someone like Warren Buffett, a lot of his money came after he was 50. So yeah, then in 30 years, again, now, if you look at your total monthly deposits are 4,000, but your interest is, 4.6 million, but your interest is 9.2 million. So you are actually earning much more than you are depositing. You basically, your earnings now have doubled what your monthly deposits are. This is what then compound interest does for you. I tried to do the same simulation without adjusting for inflation for 30 years. And you see that you would have total monthly deposits of about 1.8 million. And you would have earned an interest of 5.7. That's almost more than 3 times what your deposits are. But then again, now in this equation, you would need to consider the value of your investment after inflation, because I did not adjust for inflation in this equation. Yeah, so that's really how compound interest works. How do you make compound interest work for you? Start now. That's the only thing I can say. You want to give yourself as much time as possible for compound interest to work for you. All right. I'm going to then, yes?
There's a question on the chat that correlates to what you're saying, and I wouldn't want to ask later. They ask, why should one invest at a young age as opposed to in their 30s? And what investment would you recommend for a university student who gets a pocket money of 5,000 per month?
Okay, all right. So why should you invest as a young person and not in your 30s? Compound interest and time. If you start now, you are definitely ahead of people who will start later in life. And then also, I think if you start early, it also helps you to create the discipline that you need to continue investing even later in life. Thirdly, I think when you are younger, you have more, you can take more risk, because if you're still getting a pocket money, you will still get that money. So it's easier for you to take a risk with your money, as opposed to when now you have responsibilities, you have a family, you have children, maybe your income has not grown as much as you expected it to grow. So start now, because as long as you start now, you are giving yourself the greatest advantage, which is time, and allowing time to work for your investment. I hope that answers. Now, when we talk about the best investment for university student who is receiving 5,000 shillings per month, I'd like to answer that as I go through how to evaluate investments. And then if at the end of it, you're still not clear, we can see what we can do about it, because there are different things that you need to consider before you pick an investment. So I can't just tell you, go and put your money in X, because there are different things that I will go through that we need to understand before we pick an investment. Okay. Okay, so let's go into evaluating investments. So some of the things that you ask yourself when you're evaluating investment is, one, what are your investment goals? Why are you investing? What type of return do you want to earn with your investment? Do you want to earn simple interest? Do you want to earn, which is like a fixed income? That's like a bond. Do you want to preserve your capital? Do you want to maybe save and accumulate money to maybe get into maybe like real estate or start a business? Do you want to just see exponential growth of your savings? So what is it that you want to do with your money? Because once you're clear on what you do with your money, then you look at the risk. Do you understand the risk of different types of investments? And how does that risk match with your risk profile? So a risk profile is your own risk profile. Everybody has a different risk profile. And a risk profile is basically what a way that even investment companies will use to determine whether you can buy certain investments. Now, in highly regulated markets, it's very well used. In other markets, unless you're investing with a really good investment firm, they might not necessarily ask you to get a risk profile, which it would be the case like in this get rich quick scams. They don't really do an investment profile to understand what your risk profile is. Because for them, they're more interested in you putting the money in. So what goes into your risk profile? Your risk profile is determined by, one, your time horizon. How long do you want to invest for? If you want to invest for 1 or 2 years, you should probably get something that is short term, maybe a fixed deposit, maybe a mutual fund. If you want the medium term, then you can go into a balanced fund or a different ETF. If you want a long term, or if you have a long-term horizon, 10, 15 years from now, then you could get into something like real estate. You could get into a bond. Sometimes the government has even 30-year bonds. So you could get into longer term investments. So your risk profile will really determine what sort of investment you pick, because it depends on your time horizon. Then it also depends on your risk tolerance. So your risk tolerance is really what concerns me the most. Is it to preserve my money? Is it to avoid losses? Or is it to grow my money? So based on that, if you want to grow your money, you probably have a higher risk rating than someone who wants to avoid losses at all costs. And it could be different. So for example, someone who is maybe like at retirement or nearing retirement, they want to preserve their money so that they can use it during the term after their retirement. For someone who is a student now, maybe wants to grow their money so they can be able to put their money into a longer term investment that has higher risk with more potential for higher return. Then you also need to look at your current portfolio. All these are things that go into your risk profile. So what is in your current portfolio? So maybe your current portfolio, you've started saving, so you have some cash and cash equivalents, and now you're starting to look at maybe now I need to get some fixed income, so you might want to get into a bond. Or you might say that my current risk profile, my current portfolio only has stocks, so that means it's a very risky portfolio. How do I balance it out and make sure that I can also get some low risk investment to balance out my portfolio. It is also determined by your knowledge of investment. So if you know nothing about crypto, then you need to learn about crypto before you get into crypto. If you know nothing about the real estate market, you need to read about it and understand what is involved in the real estate market, what are the opportunities available. So you also need to determine your knowledge of different investments. So then once you have worked on your time horizon, your risk tolerance, your current portfolio, and your knowledge of investments, and you could even find some of these, if you just Google investor profile questionnaire, you could get some online that you can fill in, and it would help you to see where do you stand. So based on that, you would end up either having a conservative profile, a moderate profile, or a very aggressive profile. So if you have a conservative profile, then there are the investments that are best suited for a person with a conservative profile, where they will be looking to preserve the value of their money and avoid losses. A moderate profile, they're saying, okay, I'm willing to take some risk and get some return. A highly aggressive profile is someone who will be saying, I just want to make returns. I'm happy to take a loss, but if that loss means that I can also grow my income, I'm happy to take it. So depending on that, then you will create your own investment strategy. Then based on my profile, what are the best ways to invest, and how then do I balance out my portfolio? So then you also need to ask yourself, do you have any existing debt? Because as we talked about last time, if your debt is accruing a very high interest rate, it is more prudent to pay off your debt and then start investing. So that if you have like these short-term loans by apps like Tala, they charge you a very high interest rate. So you want to be able to pay that off and start putting your money where you can make a return. Then do you have an emergency fund? Because you also don't want to be in a situation where every time you're in a fix, you liquidate your investment. So you want to be able to allow yourself to stay in your investment for the term or for the investment horizon that you have decided for yourself. It also helps you to mitigate against risks such as the horizon risk, where perhaps you have a 10-year horizon but you lose your job, but then if you have an emergency fund, you're able to sustain yourself for the period where you do not have an income, and then you can get back into the market once you get out of that situation without necessarily liquidating your investment. Then the other question to ask yourself is, what are the costs to buy, to hold, and sell the investment? So a lot of these investments, especially when you're going through with a company, you do pay some investment fee. Some of them will have a flat rate, maybe a 2% management fee per year, or a 1%, whatever it is. You need to evaluate how much am I being charged to get into this investment? What is the cost to buy? So for example, that would very easily tell you, if you have 5,000, maybe you can't go directly into real estate. You probably need to go into a REIT, or I probably need to just put it in an MMF, accumulate it, and buy later. Then what are the costs to hold? So when you're holding your investment, is it incurring any costs? So if it's a mutual fund, you have an annual fee that will be deducted from your earnings, and so you're getting your investments net of the fee, which is also the case with MMFs. Then you also want to find out what is the cost of selling. So if there are any taxes that you need to pay at the end of your investment, or when you liquidate your investment, what are those costs? What are the tax implications? Because then that helps you to look at an investment in a wholesome way, not just from the price of getting into the investment, but also throughout the life of the instrument that you're buying, what are the associated costs? And finally, and a very important question that I think a lot of Kenyans need to ask themselves, is the return realistic? And the reason for this is because, and I think I saw a question that said, what is the best way to make quick returns? I don't know a quick way to make quick returns. I don't know, because I would like to think that I am a good investor. So I'm not looking for quick returns. I understand how investments work. So for example, if someone is promising to give you 30% in 3 months, and we've already talked about the risk-free rate, which is about 1.53%, or if you're using the T-bill rate, it's 6%. What is this person not telling you? How are they going to make 30% returns with your money in this market? Because then it might make more sense for that person to go and borrow from the bank at a rate of 13% and invest in a rate 13% annually and make their 30% in 3 months and make their return. So you also need to be very careful when you're looking at these investment opportunities. And I hate that I have to say that there are no get rich quick plans that are devoid of risk. So if you're being promised a very high rate of return, then you need to ask yourself, what then is the risk that I am taking with this? Then I had said you also need to look at your current portfolio. So if you're buying new investments, how does your new investment blend in with your, or fit in with your other investment, with your other investments? And you need to rebalance your portfolio every few years. So maybe balance it out between stocks, real estate, cash equivalents. Keep rebalancing it, fixed income, keep rebalancing it, and so that you also keep mitigating against the risks that are associated. Then you also need to ask yourself, who will manage your investments? Are you the one who will be actively involved in managing your investments? If you're not, then what are the costs of managing those investments? Then what will you do with your investment returns? Will you reinvest them, or will you take them out and enjoy the fruits of your investments? So those are some of the things you need to decide before you get into an investment. And finally, what are the different barriers of entry? So for example, real estate is more expensive to get into. You need a lot more documentation. There's a lot more process that, a longer process that you get into before you get into that market, as opposed to maybe calling up a stockbroker and creating a CDS account and starting to invest in the stock exchange. So it depends. So what are the barriers to entry that are available for each investment? I hope that answers the question of how best you can invest your money. So I'm really avoiding telling you go and put your money in X, because I don't know what your risk profile is, and I don't know what your goals for this investment are. So if you can ask yourself these questions, I'm also available to help you in a more personalized session to decide where or how best to invest your money. That's one of the things we do at Tana Coaching. Okay, I see. How can one access a certificate of deposit account? I would say for this, check with your bank and what options are available for you. Yeah. Any other question? Okay, are we still together? Because if there are no other questions, yeah. Thank you, Mark. All right. That's what I had for today. I hope this helps. So I'll talk a little about what we do at Tana Coaching. So when I founded Tana Coaching, it was really just to be able to help people to walk through this journey of financial planning. So what I do is we find out, typically when you sign up, we will do a financial wellness assessment so that we can tailor the content to your needs. Then we'll go through an introduction where we go through your financial wellness answers, understand what are the things that that impact your money habits, and agree on the format that we will use for your coaching that is most useful for you. We handle topics such as budgeting, because I believe that you need to be able to manage your income and expenses effectively if you're going to start investing. Then we talk about tackling debt. What is good debt? What is bad debt? How do you make debt work for you? How do you pay off debt? How do you plan for emergencies by creating a good and a robust emergency fund? Then we go through investing. And so when we go through this investment, other than the content we've handled, then we will do this at a more personalized level, where then we're doing this together and evaluating then what are the best options for you. Then we talk about saving for retirement and how that helps you. If you want us to talk about it, we would talk about relationships and money, kids and money, and how to prepare for it. And finally, I give you an option to remain accountable, because I believe the coaching process is not complete without you, without establishing ownership and accountability. So we agree on some check-in sessions, at least two quarterly sessions. And then after that, if you still want an additional check-in, we could work out an arrangement on how we can do that. So what we basically do is we help you to build a positive relationship with money, so that you can establish healthy spending and saving routines that will help you to maximize your wealth. So why should you come to Tana? One is, as I said, personalized content. Every person has their content tailored to their specific needs, because maybe for you, you want to get out of debt. Someone else wants to learn how to invest. Someone else just wants to learn how to grow their income. They're moving jobs. We talk about what are the different options of growing your wealth. What are the additional businesses you could get into? It's private, it's confidential, it's just between me and you. I do not judge, and I hope that my coaches can attest to that. And because of the issue of accountability, we want to ensure that it is lasting. The greatest gift to myself, or the greatest thing that I can achieve, is to be able to see that I'm in reality impacting lives and having people who are enjoying lasting change in their financial habits after they have gone through the coaching. Then what I also incorporate in these coaching sessions is that I understand that financial goals are just a small part of your life. So I incorporate some life coaching into the conversations, so that you not only work on your financial goals, but set yourself up to achieve success in your life. So how do I do this? I normally have coaching sessions every 2 months, and it can either be in person or online. I do this very early in the morning on Saturday or Sunday. So you pick a session, a 1 hour session for 8 weeks, where we go through different the whole syllabus. So between 7 and 8:30 a.m. on a Saturday or a Sunday, and between 8:30 and 10 a.m. On a Saturday and a Sunday. I only handle a maximum of 4 people for every 2 months, because I also want to be able to ensure that I'm giving you value, and that when I'm in your class, I am focused on what I'm giving you. What's the cost for this? So the total investment for this is 25,000 shillings for the 8 weeks. However, for anyone in the session, I am running discount. So for the first 5 people to sign up, you can do it at 15,000 shillings for the 8 weeks, which is a massive bargain. I can tell you that it is life-changing, and you will be able to put your finances in order. And then for those who are familiar with investing, but maybe there's a are familiar with personal finance, but there's a topic that you would want someone to walk you through, I also have 1 hour sessions, and I only charge 3,500 for the 1 hour session, which then we delve into a specific topic and as and how you would need. And even after those, I'm very keen on following up with whoever I have been coaching to ensure that they are actually putting into practice the things that we discuss. Yeah, that's it from me. Again, thank you very much for joining and for lending your time. If you would like to reach out to me, you can call me. I'll post my details, my email, my number, and my Instagram handle. I only just started an Instagram handle, so it's not a very busy account, but if you DM me, I will be able to reach out to you. Yeah, that's it. And thank you very much. Over to you, Kevin.
Thank you so much, Rachel.
Okay. Sorry, I see a question from Alton. Is it better to save money in a bank or SACCO? So as we talked about, so what you need to look at, what rate is your bank giving you? What rate is your SACCO giving you? Now, I need to say that if you're saving money in a SACCO, as money you want to access, that might not be the best option, because how SACCOs work, you cannot withdraw your money unless maybe you give a 3 months notice. So that's how SACCOs work. So you're not able to get back your money. Also, when you get into a SACCO, you have 2 ways. So one, you buy shares in the SACCO, and your shares in the SACCO are not refundable. So a SACCO will say you need to buy 400 shares to join us, and valued at maybe 40,000. So you cannot get back your 40,000 unless you sell your shares in the SACCO to a willing member. Your savings, you can only access them with maybe a 3 months notice. I think most SACCOs have a 3 months notice if you want to withdraw your money. So the way you get your money back from a SACCO is through a loan. So you borrow them either part of your savings or your savings up to 3 or 4 times. So if you're saving for the purposes of having access to your funds, a SACCO is not the best instrument for you. If you're saving and you want to make money, you want to get an interest, and you also want to have access to your money, you might want to save that money in a money market fund as opposed to a SACCO. If you put it in a bank, the interest rates that the banks give are very minimal. So I think maybe some of the best rates are maybe like 5 or 6%. You can get higher somewhere else. So then you need to look at it that way. But you also, so you want to look at how, what access do I want to my funds, and what is my saving for? So if I want to buy myself cheap credit in the future, and when I say cheap, I'm very careful, because I know there's also the debate where people say when you're borrowing from a SACCO, you're borrowing your own money at a higher cost. So there's different things, but if you want to be in a place where maybe you can get access to a loan much faster, you might want to put it in the SACCO. But that said, I think a lot of banks are also moving towards simplifying the process of getting credit, and therefore you might even find a better option of credit with a bank than with a SACCO. So those are the different things and the different ways in which the market is changing. Yep. Thank you for that question, Alton. Okay, do you have any other question? Okay, looks like there's no other question. Kevin, over to you.
Bia is asking about banking in the US, in USD.
Okay, banking in USD. Okay, so I'll briefly touch on it. So one, if you're banking in USD and you're earning in Kenya shillings, you definitely expose yourself to Forex risk, because every time you will convert your money into USD. That said, if you are interested in investing in USD, it is in your best interest to open a USD account, or if you earn in USD. Most banks will give you an option to open a USD account. I don't think there are many regulations. So for example, if you already have an existing account with a bank and asking to have a USD account, it should be a fairly straightforward thing where they just give you an additional account number tied to your current account that is now in USD currency. Then with that account, you can be able then to get or to access other investments that are available in USD. But you need to remember that if every time you're investing in USD, you're first converting your Kenya shillings to USD, you need to consider that the losses you make when converting KES to USD as part of your investment. I want to say part of the cost of investing, so that when you look at your returns, you're looking at it from when you convert, what money you lose or make, and buy your investment. And then at the end of it, when you liquidate, what are the Forex gains or losses that you might incur when you liquidate your assets. But it's quite, I think it's quite easy to open a USD account. I don't think there are that many restrictions, at least not that I have encountered. Yeah, thank you, Beatrice, for that question. Cool.
So with that said and done, I think we can call the session to a close. On behalf of the Financial Senate, Jamal, Laurel, and the team, I'd like to thank you, Rachel, for taking the time, energy, and thought into coming to this wonderful Zoom meeting and sharing the vast amounts of knowledge and intellectual wealth that you've gained in your time on planet Earth. As always, you're always spitting gems. And for me, on a personal note, I didn't really know about real estate trusts and how they're helpful when you don't have a lot of income to invest in real estate. That definitely got me interested in real estate a bit more. And I think on behalf of everybody who's been here, there's been something you have said that has shifted a perspective or has enlightened them on an issue they were dark about. So in case you missed something or you want to hear it again, this Zoom recording has been streaming on YouTube on the Student Council page. Go ahead and like, comment, and subscribe. And with that, I would like to say thank you for coming. Have a fantastic weekend ahead. It's been a pleasure having you, and we will see you next time.
Thank you. Have a lovely weekend, everyone. Bye.